name is Jonah Katsenelson, and I'm Vitaly's son. Thank you. Small rooms like this have a way of holding big conversations, and this get-together started a few years ago with only 12 people in a hotel lobby. This year, we have over 1,100 people signed up. This is my 6th Berkshire weekend and my father's 16th, and somehow, amongst some of you in this room, we're still considered rookies. For those of you who don't know him, my dad was born above the Arctic Circle in Murmansk, Russia, and came to the US in 1991. He's the CEO of IMA, a value investing firm based in Denver, and Forbes once called him the new Benjamin Graham. He's written for the Wall Street Journal, Financial Times, Barron's, and he has 3 kids as well as 3 books. People often ask him, which book is his favorite? And he says it's like asking which kid is his favorite. And he's got a 4th book on the way too, and luckily not a 4th kid. He's a philosopher, a public speaker, and a husband to my mom, Rachel. A couple of quick things before we get going. We have a fantastic author lineup, and their books are right outside, so please go say hello and pick something up. We'll also be giving away signed copies to the first 20 people who ask questions, signed copies of Soul in the Game. We have 2 mics from each side of the room, one right there and one right there, so just please feel free to line up with questions. And just one quick piece of advice. Asking Vitaliy a question is a lot like prompting an AI model. Craft a good prompt and you may get a good response. With Vitaliy, what you see is what you get. He's a little hard of hearing, and others in the family would say he has selective hearing. But either way, when you ask questions, please project so that he can hear you. But I'll tell you this, there's no amount of money you can pay him to stop answering questions. He loves sharing what he has with the world, and what he has to share is usually thoughtful, often surprising, and almost always worth hearing. Many of you know him as the paranoid Russian Jew. Please welcome to the stage my dad, Vitaliy Katsenelson.
Well, thank you, Jonah. All right. Well, first of all, thank you, all of you, for coming. That means so much to me. I truly mean it when I say this. Jonah is right. I think the first time we had a get-together, it was a DoubleTree hotel, and there were like 6 or 10 of us, and we having ice water. You know, that's about it. Anyway, but first of all, I also want to thank. First of all, there's so many friends. My family, my daughter is right there, her fiance is there, have my dear friends here. And, but I really want to thank my IMA team. Cyrus, right there, Robert. That Robert is a big, geeky-looking guy at the up front somewhere. You know, they've done an incredible job putting it together. And obviously my AI star, my producer, director of marketing, my son, whatever titles you want to create, I'm fine with that. Jonah. Okay, and so I just want to warn you, this is not a marketing event, and I really mean it. So when you direct your questions to me, please don't ask me kind of marketing-like questions about IMA, because that's not what I'm here for, and I really mean it. So if you want to talk about my company specifically, here's Cyrus right there. You can attack him, or you can talk to Robert. But I am really here just to answer as many questions as I can. And my colleagues asked me to try to be succinct. So I'll try, though I don't think it's going to work, but we'll see. All right, so just ask away. Here's the microphone right here and here. Yes, Albert, right there.
Yeah, and feel free to line up, everyone, if you have any questions.
Thanks for the invite. In your, I think it was your last letter, you wrote something about learning from your mistakes, and specifically, what are the mistakes that you've done that would prevent you from learning into other things? So, for instance, Netflix was one of the examples that you were giving. Have you made any further thoughts on that? I remember texting about this, but have you made any additional thoughts on the things that would prevent you from learning how to understand a company moving into a new business model or disrupting an existing business model? But because it goes beyond the purely financials, right?
Yeah, Albert, thank you so much. So it's actually very tricky. So investing, it's a process with a lot of randomness. You know, the investing is random. There's a lot of randomness, and sometimes some mistakes we should learn. Okay, let me be very precise here. First of all, you have to differentiate between if you were to learn from your I want to separate this because this point is very important. You bought a stock and it went up, and we usually don't look at it as a mistake because you made money. It still could be a mistake because you had thesis and your thesis was wrong and you made money for wrong reasons, right? So I want to separate this because this is very important. So when I try to learn things, I don't just try to learn from performance of the stock. I try to learn, this is what my thesis were. Was I right about the thesis or was I wrong? That's number one. So separating stock performance and fundamental performance. That's point number one. Point number two, sometimes there is nothing to learn. Like, let me give you an example. You made an investment. You thought there was a 20% probability of this, of bad thing happening, 80% probability of this. And guess what? The bad thing happened. Were you wrong? You may not. You may not have been. You may not have been wrong. And then you sometimes just random things happen. So there is nothing to learn. But at the same time, I look at a lot of mistakes of omission I made, and those are the ones that usually don't show up on my clients. Clients don't know about this. Clients don't know that I look at Netflix, I decided not to buy. Clients don't know that actually I was at a tiny little conference and somebody presented at Netflix, and that person had a perfect thesis that played out perfectly, and I just put it into a difficult pile, and maybe I was too lazy or whatever. So clients don't know about this. So I try and. So when I look at my decisions, I try to be as objective as possible when I try to learn things, but knowing that some mistakes are not mistakes, or what appear to be mistakes, not mistakes, and so I'm doing such a. By the way, I'm doing such a horrible job answering this question. It's not even funny, and So let me do this. Let me write about this, and when I write about this, I'm gonna have a better answer.
Love it already.
Okay, so this is. Yeah,
Thanks.
All right, thank you, Albert. Let's do there, and then we're gonna go to Kim.
Hi, my name is Mahendra. I'm from Austin, Texas. My question is more of an actually seeking advice rather. Considering essentially like knowing, keep everything that you know right now, but take out your celebrity status. So basically strip it down to like kind of my level, minus five people with whom I came here. Nobody else knows me. Under that situation, how would you like start in and probably raise money and then get the confidence to invest some other people's money in a way that you do now, but without your celebrity status? How, or put it in another way, what advice would you give it to me starting at that level?
So the question is this: you want to start an investment firm,
Right?
Do you love managing money?
I do.
Okay, that's good. All right, that's a start. And okay, and then the question is how would you market yourself?
And more importantly, like how do I get that courage of like basically how you do the investing? When it is my money, I work in a different way. But if I'm investing other people's money, that's where I kind of lack the courage. So for example, the COVID came in, I had all the data point, I had my mathematical model telling me I should be doing something. The emotion somehow doesn't still allow me.
So there are two questions. There's a money management question.
Two questions.
Yeah, and then there's a marketing question. So on the money management side, I'm going to speak from my experience. I found that I'm much worse at managing my own money than managing my clients' money. And let me explain the difference. When I when I got into this business, I would, I was, started to manage clients' money. I was an analyst, so I was just helping somebody else manage money first. We would spend weeks, sometimes months, on doing research for our clients. And at the same time, at the time, my money was managed separately. Like I would not, the company was not managing my money. At the same time, I was an embarrassment when it came managing my own money because I would literally remember, honest to God, watching CNBC and somebody said something interesting about the stock, I went out and bought it. So I've kind of, and then I look at the track record of my personal track record, and for me and the track record for my clients, I realized that it was horrendous because I was really just gambling with my money. And so at that point, I decided for two reasons. First of all, I actually want to grow my wealth. And second of all, it's probably the right thing to do. And now my money is managed the same way my clients' money managed. In a sense, I'm just an account at IMA, okay? And what I found is this. I'm a so much better investor when I manage money for somebody else because I'm incredibly process-driven and a lot less emotional. So, by the way, this is important insight, is that that's how I work. You may have different wiring, but in my case, the wiring was that I'm like when we do research for our clients, it's just the responsibility to me is so great and I try to be as process-driven as possible. And therefore, my money just becomes an afterthought because if it's good for them, it's good for me. So that's point number one. About marketing, you may not believe this, but you're talking to the worst marketer in the world, okay? And honest to God, because I happen to love writing, okay? And people like what I have to say, and then they start reading my stuff and keep reading my stuff. That's all I know about writing. That's really all I know about marketing. But I'll tell you one thing when it came to writing, for me, another story. I started writing in 2004 for TheStreet.com. And in late 2004, maybe early 2005, I wrote the Financial Times and said, I would like to submit an article for you. And the audacity I had, the arrogance, and they took it. So there was I think there is an element of fake it till you make it. But here's the point. When you're faking it, it's not you're trying to deceive others, you're trying to deceive yourself. You're trying to, you basically tell yourself, I deserve to be doing this, even though you may or may not be. But this is what drives you forward. Because if you constantly have self-doubt, you're not going to go anywhere. So that's my answer. So hopefully it helps.
Thank you. Thank you.
My pleasure. Kim, and this is my great friend Kim. So Kim, thank you so much.
Thank you. Vitaliy, you started out by writing the Active Value Investing book and the little book of Sideways Markets. So you are a world-class expert in sideways markets and range-bound markets. Are we in one now? And in your book, you highlighted that in sideways markets, value investing does extremely well. And so I'm curious, are we in one now? Is this a great market for value investors today?
Oh, Kim, well, first of all, Kim, thank you so much. This is like one of the best Canadian investors, period. So, and Kim, actually, you endorsed my little book of sideways markets. So, I basically stopped talking about the sideways markets, not because we're not in sideways markets, but because I'm sick and tired of talking about it. Okay? But just think about it this way. If you look at market returns in the long run, I mean, I'm talking about decades, they're really driven by two factors. And I'm ignoring dividends for a second. It's really what's happening to earnings and what happens to price to earnings. In other words, let's say if earnings stay flat, if price to earnings stay flat and earnings are growing, your return is going to be basically what earnings are doing. And if price to earnings go up, your return will be higher because they will accelerate it, and the price to earnings go down, they will decelerate it. And then you collect some dividends in the process. Well, today, the market valuations are one of the highest levels ever. So the earnings are going to be, the price to earnings are going to be a headwind, not a tailwind. And as price to earnings decline, and plus we're probably going to go into inflationary environment just because of what's going on with interest, with government, how much debt we have. And therefore, so therefore price to earnings are likely to decline. So yes, if I owned S&P 500 or some broad indices, I would be scared. Or I would be scared that for I'll wake up 10, 15, 20 years from now and my wealth has not increased. So that's point number one. But to second point, like when I wrote my first two books and I studied sideways markets, you're absolutely right. Value investing has done well. Why? Because it suffered the least amount of price to earning compression, because you had margin of safety, basically. So yes, we are in the sideways markets. So thank you so much. Thank you. All right, here's Doug.
Thank you, Vitaliy.
First, before you talk, so remember I mentioned 16 years ago we were at the DoubleTree Hotel? Doug was there. So
Also got to go to the Blue Jay Cafe.
That's right.
A couple times. That was pretty good too. My question for you, I guess following Jonah's advice, we should give you a prompt. You are a student of history. You have specialties in certain European countries such as Russia, which has given you a unique perspective on Ukraine. You also have a strong affiliation with Israel and have an understanding of different perspectives in the Mideast. And we've seen some tremendous changes in global alliances and breakups of old orders, or the partial breakup, the stretching of old orders might be changed new. I'm not asking for a stock, but how does the changes that we've seen that I don't think are going to go away in 2028 at the next election, I think we're going to, whoever wins in the future, I think some of these changes are permanent from the United States. How does that check what can happen to world economies and different players, and who might you think be winners out of the new world order, and what areas have worked great in the past that you think maybe are on their last hurrah?
all right, thank you. No, so this is such an important question, because so I got to tell you, and I don't think I shared this before, but today I am as concerned as an investor as I was concerned, maybe a little bit less than during great financial crisis, but almost as concerned as we were during COVID. Because the world is changing in front of us, and the world order is changing very, very fast. And then you throw AI into this whole thing, and it's just, things become so much more complicated. And in the past, U.S. was this kind of it was the most powerful nation in the world that projected this image of sanity, power, rationality, I guess, and strength. Yeah, and this is not necessarily the case today, or not as much. Now, and by the way, this is what I'm saying right now. This is apolitical. This is not. This is how I see the world. I would have said, if we had a Democrat in the White House, I would have said something similar. If I saw what I see, if I saw what I see today, and us withdrawing from the rest of the world is, as of right now, who's winning? Not the United States, but I would argue China is winning more, I would argue that our alliances with Europe are getting weaker every single day. I think you saw German Chancellor say that something along the line that we are humiliating ourselves with the war in Iran, or at least how we're behaving. Okay, so at least that's their perception of this. And by the way, just part of the reason attendance this year to Omaha is much lower, not just because Buffett retired, but also because we have Canadians who don't want to come to the United States. Europeans don't want to come to the United States. But I had a lot of emails from my friends in Europe who used to come here, and they said, again, they don't want to come because of what happened in New Zealand, whatever. So that is how the rest of the world is looking at us. So at the same time, we run 6% budget deficit in peacetime. And United States became what it is today, somewhat by luck, because we have an incredible geography. We have Canadians, we have Mexicans, nobody, they don't want to fight us. We have oceans on both sides. We have incredible, rich soil, great geography overall, right? But some of it was earned because we have an incredible constitution, rule of law. We behave in a certain way. But also because we have alliances. And I think that has been just, little by little just declining. And therefore, I'm kind of going to the answer, is that I think US dollar as reserve currency US dollar will not, it's still going to be the reserve currency, but just going to be, people will use it a little bit less over time. It's not going to happen overnight. And by the way, another thing that's, anyway, so what does it mean? There's most people here are investors. What does it mean to me as an investor? Well, today as an investor, I think you need to have a lot more humility. And humility because I have the range of outcomes in the future is so much wider. And therefore, the way I express my humility by saying I don't know a lot, by reducing position sizes, by diversifying more, not just United States, outside of the United States. They actually bought gold, just a little bit of gold, just for one simple reason, because, I think the debasement of all currencies, like Europe, all things I said about the United States, Europe is worse. So anyway, so that's kind of how I view the world. And my goal at the end of the day is not necessarily have the highest returns, but to have returns, okay? And I just, because a lot of times, we manage now all my net worth, but a lot of times all my clients' net worth, and I just don't want to screw it up. I just don't want to blow up. I just want to make sure we grow their wealth. So this is why when I construct portfolio, well, if I sound like paranoid Russian Jew, I am. So that's the answer you get. So thank you, Doug.
Thank you very much. This is why I keep coming back.
Oh, my friend. Thank you.
Hi, my name is Angel. Thank you so much for coming here to speak today. My question to you is, what drives you? What motivates you?
Oh, that's so easy. I absolutely love what I'm doing. I have a dream life. And because I get up in the morning and I write, and I love writing. But the thing is, I don't want to write the full day. I can write maybe a couple hours a day, and then after this, I just get tired. So after this, I drive my 12-year-old daughter to school, and I enjoy this 25 minutes in the car we have, and we listen to music, and with her, she's a bit luckier than my older kids because we actually don't just listen to classical music, we listen to all different music. So last week we were listening to Michael Jackson. That's what I mean. So all different music. And then I get to work, and I work with wonderful people, and I love investing. I have a lot of great friends, and I talk on the phone a lot with my friends, and a lot of them are investor friends. So we talk about stocks. So I just love what I do. So that's what drives me. One thing I found, I was thinking about similarity between writing and investing, and curiosity. Think about it. As a writer, you always look for new ideas. So you're very observant, you're curious. You start looking, you kind of look for ideas. As an investor, if you really love it, if it's your passion, same thing, right? You always look for new ideas, right? And you are not just looking at your ideas when you read any reports. You may be watching the movie and like, oh, I didn't think of this. So anyway, I get to the activities that that tickle my curiosity. So so that's what motivates me. That's what drives me.
Thank you so much.
Pleasure. Thank you.
Hi, thanks for doing this. My name is Abhishek Kumar. I'm here from Irvine, California. And let me give you some context before I ask my question. So I've been trying to learn the value investing principles and everything for the last 10 years plus, and I think I understand the principle. I have few stocks which have done well with my long-term horizon, but the initial amount I put was not that much so that it could be life-changing. The question I'm asking is, my goal is to be financially independent. So how do I balance being patient enough to give enough time for my investment to play out, at the same time being impatient enough so that I get my financial independence in, let's say, 10 to 15 years rather than 30 to 40 years?
All right. Well, you got the value investing part figured out, so you don't need my advice there. Just keep your costs low. I mean, that's probably just keep your expenses low, and then you get both. You got the revenues, or you build in your assets, and then when those assets start producing income, just make sure your expenses stay low and save as much as you can. I guess that's the only thing I can suggest.
So, but let's say if like you have a bit of a longer feedback loop anytime you put an investment and like let it play out. So they're like fewer bets, big bets. So like something plays out like, let's say 5-7 years. Like how to make those like few bets which like eventually could be like life changing.
So this is where, okay. So all right, this is a different question. I am not sure, and when I say this is from my personality. I agree with a few big bets, because this, by the way, when I say this, I'm basically disagreeing with Charlie Munger. But and I think it was fine for Charlie Munger to make those few big bets. If I did this, I'm not sure I would be able to sleep well at night. Just again, that's my personality. So if you decide to do a few big bets, make sure that it doesn't undermine the quality of your life. And what I mean by this, if you can sleep, some people, if you sleep well at night, making those few big bets, that's fine. If this keeps you up at night, then maybe that's not for you. So just a reminder, the life happens not when you retire, the life happens today. So as you are going through this, you want to make sure that you are actually a sane human being and not a nervous wreck. Okay, so the few big bets may work for some people, obviously work for Charlie Munger, but he had a kind of ice water running through his veins in that regard. If that's the case with you, that's fine, but you want to make sure that actually fits your personality. Doesn't fit mine. So this is why I don't like. This is like actually a bigger question of portfolio construction. Do you like some people like can run? I have some friends who run 10-stock portfolio, and then I have other people who run portfolio of 200 stocks. Both extremes are not what I want or what fits me, my personality, and what probably fits my clients too. It doesn't fit my clients either. So for me, few bets means 20 to 30, 35 stocks. And that's with that number of stocks, I feel sleep at night. I feel sleep well at night, and that's what works for me. So hope that answers your question.
Thanks so much.
My pleasure.
Yeah, hi. So, love Jonah's intro to you. Clearly, you have compounded well there. My question is about my most important long-term holding, my son. How do I raise him so he doesn't turn out to be a entitled prick? when technically he never has to work a day in his life, and pretty much most of his friends will not have to either. So any lessons there?
Oh my God, this is such a great question. Plus, I have two kids in the audience, so they can. So it's kind of interesting. So I actually know the answer to the question because I wrote about this. Sometimes when you ask me a question, I don't have an answer just because I didn't think enough about this. But raising Jonah, he's my oldest son, was much easier because we had no money. All right, so so we literally would go to Chipotle and we would split a burrito. Okay, well, he was little, so it was easy too. So, so I didn't. It was very difficult for me to spoil him because I didn't have money to spoil him. As I got older, I had a little bit more, more wealth. Then I had to become very intentional about that. And this is, and I know that as an immigrant, my kids will never have the same drive I would. Okay, and as I want them to have the drive, but at the same time, that's kind of the whole point of coming to this country, right? But at the same time, I almost want to, I always, when I give them an allowance, I always give them 30% less what they ask for. Now, it's tricky because they start gaming it, right? So I have to, but I always, I think it's, so I just wrote in this new book that's going to come out at some point called What a Life. In this book, I actually talk about this topic. And we live in the United States in the country of abundance. And it's easy for me to say because I came from Soviet Union and I've seen what scarcity looks like. But we look at abundance as this great positive thing. By the way, between the Soviet Union and the United States, you know what my answer is, right? However, I think there is some value of mindful scarcity because that the scarcity or constraints force you to make choices, okay? And so what I try to do with my kids, I give them an allowance, but it's always not enough or not as much as they think, as they think they need. And then they have to make choices and they have to give something up. If they want to go to the movies every day, well, then they have to give, not eat out every day. You see what I mean? So that's what I was doing with my kids. And another thing, and this is just kind of general parenting advice, just spend time with them. Just, hopefully answer that question.
Thank you. Thank you for the book.
Oh, my pleasure. Thank you.
Wow, after that question, that's a tough act to follow, but I'm going to give it a shot. First off, thanks for being here. My name is Tom. I'm from Henderson, Nevada. And I will first say I have not read your favorite classical music, but that resonated for me. You spoke earlier of being dispassionate and how that's a real advantage in managing money. And okay, yeah, we're all reasonably familiar with a reasonably linear process that takes a large number of candidates down to a few, and those that have cleared a sufficient number of hurdles will do some more work on. When you are listening to classical music, so much of the filtering has already been done for us. Everything. So much of what we encounter or hear is by the same-sex composers. So there is some sort of a discerning process that you would apply that is other than, well, yeah, everybody listens to Bach. And without it turning into an answer or a discussion that only musicians are going to be able, if you get overly analytical, musicians are the only people you can speak with. On the other hand, if you just say, well, if it sounds good, it is good, and Duke Ellington said that, so at least it comes with good, it comes from a good source. But what is your favorite classical music and why is it? What is the analytical process? And is it even dispassionate, or is that the diametric opposite of managing money?
Oh my God, what a interesting question. All right, okay. All right. There's so many layers of answers here. Okay, let me try different layers than you. Okay. All right. So there is a huge survivorship bias in classical music, right?
Yeah.
Bach's Beethoven survived. It says, and then Mozart survived. But then there's so many other pieces, composers that haven't. Like, I'll give an example. Mahler, which is very popular composer today, was basically that composer until Leonard Bernstein brought it to life. Okay. Today, one of the most performed piano concertos is a Grieg's Piano Concerto No. 1. Well, the only in A minor, the only piano concerto he wrote, and that Arthur Robinson, he did not want to perform it, because nobody cared about it in the United States, and then they did. So, what's popular, what's not popular? I think to me it's a very personal choice. That's number one. Number two, I always try to find new classical music or discover new composers for me. And by the way, I've written plenty about this, how I would discover new composers for me that are not popular, and for me, I cannot tell you how excited I am about that. So I try to use a lot of randomness by going to Spotify. When I listen to Spotify, it throws new composers at me. But I'm not sure that I am very analytical about classical music, because, like, how do you analyze love? Like, how do you? It's the same thing, right? Either love this piece or you don't, and it's extremely personal. So, so let me give you this analogy. Seneca has this saying, time discovers truth, all right? And this is what you try to do in investing. I'm not sure I will discover truth when I listen to classical music, in the sense, like, there is no discovery process of truth when it makes me feel great or not. Just either how it impacts me emotionally. When I look at stocks, that's not what I'm looking for at all. And my favorite class, but in one last thing, and I wrote about this. There was an article, like something about me and my favorite composers. I discovered that my favorite composers happen to be Russian composers. I have no idea why. I love Tchaikovsky, Rachmaninoff, and then I love other ones too. But for some reason, their frequency resonates with my frequency, and that's, anyway, I don't know if I answered the question. I'm not sure there was an answer to your question.
If it sounds good, it is good.
All right, that's great. Thank you. All right.
Good morning. Thank you for the opportunity to address you, and thank you for this meeting. My name's Tony. I am an individual investor from Minneapolis, and I'm curious to know, as a value engineer, what your perspective is on AI relative to physical AI manifesting itself in the form of whether it's humanoid robots or it's autonomous vehicles and so forth. I understand you wrote, and I didn't admit that I did not read, you had written something relative to Tesla and Uber. Can you talk about that and its investability from a value investor's perspective?
That's a great question. Thank you. So let me give you an analogy on this. The internet came around in a kind of wide form in late 90s. But its adoption, or it started to matter really, for the most part, when iPhone came out. This is when everybody had an iPhone, kind of internet in their pocket. And I would argue the physical AI will be the kind of the iPhone moment. It's still going to be important, like the internet before 2009, whatever that, 2008, was important, don't get me wrong. But that just changed the curve. And I think that's what it's going to, this is when AI is really gonna, it's going to accelerate. So I look at physical AI as kind of, this is, physical AI is going to be kind of the next phase. They're going to change the curve. So I'm constantly thinking about this. So yeah.
And you said 28, 29 is kind of your crystal ball?
No. That's not what I mean. So
okay.
Internet came out,
okay.
Like the dot-com bubble happened in 1999, 2000. This is when everybody had Netscape browser installed, okay? But for next 8 years, internet spread out.
Okay.
But the impact on the economy started to happen when iPhone came out because everybody had internet in their pocket. So today we are kind of in 1999 type of territory, and it's already going to impact many jobs, don't get me wrong, and our lives. It's already impacting the software industry. But I think the curve of adoption and impact is going to change when large LLM will integrate with the physical, with robots, etc. Then it's going to be kind of the iPhone moment for AI. I hope
Yeah,
that was
very good. Thank you very much.
my pleasure. Thank you.
Hi. Hi, I'm Laura from Colorado. This is my 4th year, so thank you for having us again. I really appreciate that you do this and that Berkshire has this culture of education and sharing ideas among people. So the first thing I want to say is thank you for coming to the US. We are net positive on immigration for having brilliant minds come to this country, and I thank you from the bottom of my heart.
Thank you.
I have been amazed by your kids. They are so part of your life and your life's work. So my question to you is, we live in chaotic times, but I can look around this room and I see my friends, and I know personally, I'm not very impacted. I am very, very fortunate. And I look at the family that you have built with your wife. I admire that. And I guess my question is, what has surprised you about raising kids that has informed your views on investing and just your life practice of investing?
Wow. So I'm not sure it impacted me as an investor, but I got to tell you, it's probably impacted me as a human being so much more. When I became so there's probably several events that changed me as a human being. First of all, writing. Second of all, having kids. And third, kind of losing my father. So you become an adult when you lose a parent, I guess. Yeah. And I lost my mom when I was 11. So I don't think I don't think I processed it. But I lost my father when I was an adult. And so that really impacted me. In fact, that book I just wrote, What a Life, that's kind of me kind of processing this impact and put it in the words. But kids, like having kids had incredible impact. I'm trying to figure out, you start seeing the world through their eyes. Mm-hmm. You almost you get to re-experience life again as an adult through their eyes. And that probably made me a lot more intentional and mindful. And also, what happens as a parent, you realize that your kids copy not what you say, but what you do. Mm-hmm. So suddenly you have to become a role model. And so suddenly you have to kind of elevate your behavior. And that made me kind of a better human being, I guess. That's, they made me better, I guess.
Okay.
That's the answer.
Fair enough. Thank you.
My pleasure. Thank you.
Hi, Vitaliy. Thank you so much for hosting us. My name's Matt Rappaport. I'm from Atlanta, Georgia, and kind of picking up on that theme a little bit. I have a 1-year-old daughter who I adore, and hopefully another one on the way. No pressure.
Hopefully she has a babysitter.
Just say it. November 2026, but who's counting? So Mr. Market will give you opportunities over time. I've been lucky enough with Berkshire in 2009 and Google in 2020. It just hit me in the head, now's your entry point. What techniques do you use to combat anchoring bias when you have a initial purchase price, particularly on long-term winners, where the opportunity set should be evaluated freshly on an ongoing basis so you can continue to dollar cost average into those winners?
I think this is one of the most difficult things in investing, one of many. But I was not very good at that in the past. and then I got better. And I got better by just looking at forward returns. So one of the biggest change in our process we made maybe, I don't know, 7, 8 years ago, maybe even before that, I started looking at the price 4 or 5 years out. And we just, for every stock in our portfolio, we compute IRR, like to some point in the future. Sometimes 5 years out, sometimes 7 years out, sometimes even longer. Depends on the company. And then I just look at these IRRs. And there are a few decisions that we made that were somewhat uncomfortable, but then I kind of learned to appreciate them. Like we bought this oil stock a while back, and it doubled. And then they came out with a new project, and we just changed the fair value of the company, and we bought more of it. Like old Vitaliy would never be able to do this. So I guess that's the technique that worked for me. And I'm still work in progress, and that's a good thing. But those are the things that I did that helped me to anchor less. And by the way, the same thing works on the downside, is that, like as an investor, you buy a stock and something changes and declines. The old Vitaliy would have tried to rationalize himself into holding the stock. The new Vitaliy doesn't. I just, like we had early February, I woke up one day to find out one of my stocks is down 30%. And in the news, I looked at the news and I realized everything has changed. So we sold the stock the same day. Just was completely out. The old Vitaliy that tried to rationalize, but 30% cheaper, etc. This Vitaliy said, I have no idea like what it's worth anymore. And another, actually, I'm not answering your question. I'm just giving a speech now at this point.
We appreciate it.
But another element I found is that on this side is that something nobody talks about is how much mental energy consumes when your thesis completely breaks and now you just kind of hold and pray, how much mental energy it consumes from the rest of the portfolio. So so the decision I made, I thought it was a rational decision. I'm very uncomfortable. And then 2 days later, I felt like just the weight was gone. I didn't have to, try to figure out, to recreate new thesis again, and just have moved on. I really forgot about it. So anyway, just those are the things. I think you as an investor evolve, and as you as a human being, if you as a human being, you want to get better. And that's how I look at it. I try to get better all the time. So anyway.
Thank you.
My pleasure.
Hi, I'm Joel from Omaha. We've corresponded, and it's great to see this room looking so huge. I remember coming here when you were just starting out, and it was just amazing to see the growth. The way that this growth is happening, I kind of wonder if in about 3 to 4 years, you're going to be over at the CHI Center, and Berkshire is going to be in this room. So watch out. So I guess my question is, after last year's announcement, you had a fairly brutal assessment of the years recently of Berkshire. And I wonder, now that you have at least 3 to 4 months of a runway with Greg truly in charge, and a newsletter from Greg and a meeting with Greg presiding over it, has your view changed? Do you feel like there are some changes in Berkshire that are positive? Thank you.
Oh, thank you so much. First of all, thank you guys. The reason this room has so many people because you are here. So thank you very much for that. So I think I have changed my mind a little bit. And let me tell you what changed my mind. It's actually Tim Cook retiring. And I had this new mental model. And here's the mental model. When Steve Jobs Steve Jobs died and Tim Cook took over, there was no other Steve Jobs. There could only be one Steve Jobs. That's the way it is. That's the way life is. To have Steve Jobs replace Steve Jobs is just impossible. So then the question is, what kind of CEO you want to have running Apple. And then Steve Jobs got comfortable that Tim Cook is not a product guy, but he made Apple run well. And if Jobs was alive, and and both of them, Tim Cook and Tim Apple, I'm sorry, Steve Jobs and Tim Apple were there, would it be more successful? Most likely. But I think Tim Cook has done an incredible job, running the company when he took over from an incredibly charismatic, strong, visionary founder, right? And I look at Berkshire Hathaway today, and I'm thinking, does it really actually need Buffett? Actually, maybe it doesn't. Maybe it does need Greg. Actually, I'm going to give you my next article is going to have this headline. And it's going to say, is Greg Abel? But I think if you look at Berkshire Hathaway, like Buffett was always, only Buffett could have made it into what it is today. And it was capital allocation, it was charisma, it was this magic. Steve Jobs had magic, so did Buffett. That magic only, there was no way an ex-CEO could have this magic, okay? So then, that's number one. Number two, with all Buffett's magic, he was not great at everything. He did not want to micromanage those businesses. And I complain about this all the time because I love Dairy Queen. And if you guys been to Dairy Queen, the ice cream is still good, but the stores are embarrassingly horribly looking stores. They're run like mom and pop stores. You can still see boxes and it just, the food is horrible actually, by the way. The ice cream is good, but the food is horrible. But to me, little things, and in the context of Berkshire, Dairy Queen is little, tell you a lot about other things. I mean, you look at, by the way, you don't have to even look at Dairy Queen. You can look at Geico, has been undermanaged. You look at the Burlington Northern, one of the worst performing railroads in the United States. So, again, I think today Berkshire needs Greg because you need a kind of this type A personality that's going to improve the performance of operating businesses and may do uncomfortable things. You may have to lay off people. You may have to actually sell some businesses. And so, yes, I think this is, by the way, the future of Berkshire is not as bright from compounding perspective as it was in the past, just because it's so large. And I think Greg's magic is, unless we have some kind of market meltdown, he can't be able to buy things on the cheap, it's not going to be capital allocation. It's going to be just making Berkshire, let me put it this way, he's going to make train run on time, literally and figuratively. Okay, so that's my answer.
Thank you so much.
My pleasure.
Thank you, Vitaliy, for hosting us. It's my first time in Omaha, and being able to attend Berkshire and your event is really feels special. So I wanted to ask you some bit more of a hypothetical or philosophical type of question. So a little bit of context. I always think purpose in life is there's family, there's work, and those are the things. For some people, maybe more focus on one of those aspects, but for me personally, it's I want to have a good balance of purpose from work, adding value somewhere, purpose from family, have a 10-month-old, want to make sure she has a good life, and so does my wife. But it's also at times feeling a little maybe lost, or it's am I doing the right thing? And I think the question I wonder, and I want to pose this to you, let's say tomorrow you were told you cannot do investment management, you cannot write, and now you have to find something new to find purpose, to put your soul in the game, so to speak. How would you go about finding that purpose, and how would you live your life that you can still live a fulfilling life, provide to your family, friends, and be happy?
Wow. Well, thank you for this question. So let me just rephrase the question. You said basically I'm gonna amputate your 2 legs. How are you gonna walk? Honestly, I have no idea, because investing is such a big part of my life. I have no idea what else I would do. This is why I will never retire, because I love it so much. So I honestly don't know. That question terrifies me a little bit, because I don't, have many hobbies. I don't watch sports. I write, but I can only do so much of that. So I don't know. I think that's my honest answer. I have no idea, because there's no plan B for me. That's all I want to do all my life. So I'm sure Buffett will give you the same answers, because it's an obsession.
Yeah.
So I don't know how you replace one obsession with the other.
Okay. That makes me feel comfortable, because I left the industry, but I do personal management, like on the side only. And that is if I quit my job, I'd still be doing that. Yeah. So thank you. Thank you for your honest answer.
Thank you.
Hi, Vitaliy. Thank you for organizing this. And I've been your newsletter reader for almost last 4 years. And this is my first time I'm coming just by reading a newsletter. I've always wanted to come here. And it's so great to actually see you in person after reading a newsletter and imagining about who you are and how you look. The question is about one of your recent posts, and I've also been looking at one of the companies, what you've been analyzing is Uber, which you strongly believe, even with the autonomous vehicle, they own a network, so that will continue to help Uber to grow. But the question is not about the stock itself, but the question is what kind of signals are you looking to see that hypothesis you have is still valid, and what would make it change for you to change the decision? Because I see the stock has never the market has not seen it and start overperforming. So what kind of signals you look, and what would make you to reconsider the decision?
Well, first of all, thank you for coming, and thank you for reading my articles. So I think the bear case for Uber, if the only company that's going to provide self-driving is going to be Waymo. That's it. So it's not a full bear case. In other words, the business is going to be less good. Why? Because at that point, they will be negotiating just with one supplier. And this is why what I like about Uber, I love the management, because the management is paranoid about this, and they're trying to actively create competition for Waymo. They're still working with Waymo, don't get me wrong, but they're actively trying to create competition for Waymo. And if I see that failing, then that would make me change my mind about that. Or if I see management start dismissing, self-driving as a non-threat, that would be a big bear case for me. But so far, I think it's very unlikely that this market is going to be owned just by Waymo. And you're probably going to have a competition come from different places. You're going to have somebody who develops the self-driving technology, and maybe General Motors will start including it in their cars, or whatever. So it's gonna come from many different sources, and most likely you're gonna have a lot more providers than just Waymo. But if that's not the case, then I'm wrong about the stock, and then I'm gonna change my mind. So, was it?
Yeah. Thank you.
My pleasure. Thank you.
Good morning, Vitaliy. My name is Yuri. I'm based in Boston. Thanks for organizing this event today. This is my first time here. I have a question about the importance of selling. So in your little book of Sideways Markets, you mentioned that it's important to, when you buy the stock, to decide when you're going to sell, right? And decide on the price of when you're going to sell the stock and not have second thoughts about it. At the same time, at the Creighton panel just a couple of days ago, it seems like all 4 panelists mentioned that they regretted selling too early. And so I wonder if your thinking about selling has changed since 2010 when the book came out until now. And if it has evolved, then what has changed and how has your approach changed?
Yuri, thank you. So the Vitaliy of 2010, actually, can I be completely honest? It's not actually Vitaliy of 2010, it's Vitaliy of 2005. Let me say why, because I started to write active value investing in 2005. I finished in 2007, and the little book of Sideways Markets is really just active value investing, shrunk. So I have changed over the last 25 years, or last 20 years. And actually, I wrote just about that topic maybe a couple of weeks ago, actually. And my thoughts on selling are now a lot more nuanced. Now, this, I have to be very careful about what I'm about to say. I want to make sure that, and actually, as I'm saying this, I'm thinking how much of my behavior has been impacted by the fact that we had a market just kept going higher and higher. Yeah. However, when we buy a stock, we have a fair value. And that fair value, what we think we believe it's worth at this point in time, knowing what we know today. But over time of our time of ownership, a couple of things are going to change. We're going to know the company better. Yeah. So we understand the fair value better. And also facts will change. Sometimes the fair value will decline, sometimes it will go up. And so our selling decisions will evolve. So in other words, the first modification is that the sell price I set in the fair value price. When I buy, I know that will change over time. That's point number one. Point number two is that, and I don't think that's much different from what I wrote in the little book of Sideways Markets, is that some companies that have more patience and other companies that have less patience. So companies that have a lot of optionality, that have this incredible management and can keep reinventing themselves, I'm going to be a lot more patient with selling. Like Uber, for instance, right? Uber has so much optionality because they try all these different things all the time. So I'm probably going to be a lot more patient with selling. And one thing I modified over the years, I now sell in much smaller increments. But overall, it's it's an evolving process, and I'm a little bit less dogmatic about it, about selling than I was when I wrote the little book of Sideways Markets, I guess.
Sounds good. Thank you very much.
My pleasure. Thank you.
Thank you. Ed Lugo from New York City. Thank you for doing this. You signed my book about 3 years ago at the airport, and I really appreciate it. I had the book on me, but thanks again.
I can sign it again if you want.
Yeah. In fact, your son gave me another book. It was fantastic, but I passed it along to speaker number 21.
But wait, by the way, that is the spirit of Berkshire Hathaway. No, thank you.
Yes.
This is exactly. We share the knowledge.
Oh, yes, that's right. So my question is, I'm trying to process, as a money manager, I manage my own money like yourself and also for clients. And I saw Kim ask a wonderful question on the sideways markets and whether or not we're in it. And I just want to dig a little deeper because I'm trying to process what you said, which I think is the same issue that I have. I look out over 5 years. What I'm thinking is that Warren Buffett has just under $400 billion of cash. You have Ray Dalio constantly saying that the U.S. debt situation is getting worse. And number 3, you have Jeffrey Gundlach saying that you need to be very careful at this time in the cycle. So all these things are going back and forth in my head, and I just want to get your perspective. You say you look at IRRs for the next 5 years or more, and as you're thinking about those IRRs and thinking about this macro environment that we're in with the debt situation, and I just want to get a little more sense of how you're processing that and what you're thinking.
All right. Okay.
It's tough.
So a couple of things. There's again different layers here. Okay. So number one, to create those IRRs, we have to make a certain amount of projections, certain assumptions. So our assumptions are more conservative. That's number one. Number two, our definition of quality becoming more stringent. Number three, we have reduced positions. Like humility is reduced position sizes. Now, when you reduce position sizes, now it means more stock. So if in the past I bought a 5% position, now I'm buying 3% position. So if I had 30% cash, now it's not 25, but now it's 27, just because, so that in itself leads to a portfolio that has more cash. I'm delighted to put all of this to work, but the amount of cash we have today is completely driven by just what's going on around the world and the opportunity set. And again, opportunity set, we are like a couple of years ago, and I wrote about this, we benefited from, like when the United States was overvalued, we went outside of the United States. And we invested a lot in Europe. Well, Europe went up as well now. So I'm running out of places to, alternatives. So now cash, keeps going higher and higher. So our portfolio today is a reflection of the environment. And so it is what it is. We're going to have a decline. If we have a decline, or if some opportunities come to us, we'll have less cash. But that's basically it.
I appreciate that. Thank you.
My pleasure. Thank you.
Hi, Vitaliy. Thank you for having us. My name is Julie. I'm from California. And I want to ask you about Watches of Switzerland Group, which I think you have written about, and that at least you liked it. I don't know if you still like it. I don't know the company well, so this is not a hard question. It's probably the easiest question you'll get. But I wonder if you could talk about how you think about investing in luxury, where it's highly, highly discretionary, and consumer tastes and sense of fashion can be quixotic or hard to predict. And maybe if that makes you uncomfortable, but what is different about Watches of Switzerland?
Wow, thank you so much. So I'm going to recommend a book. I'm 25% into the book, and I think it's fascinating. It's called The Luxury Strategy. And it's one of the best books, actually, probably the best book on luxury I ever read, and it's an extremely well-written book. And I'm reading it literally right now, and it's a fascinating book. What attracted me to Watches of Switzerland was that it's not a retailer. And I know this is kind of confusing a little bit because that's where you go to buy watches. So it must be a retailer. So let me give you disclosure. I hate owning retail stocks. I find my EQ is very low when it comes to retail because in the past, I don't think I ever made money in retail throughout my whole career. Why? But then I say, why is it why is it not a retailer? Because it's a dealer, and there is a big difference. When you have a Walmart, which is a retailer, you can have a Target open right next door, right? That's retailing. If you sell Rolex, Rolex gives you a dealer license, and Rolex decides if another dealer is going to open next door or not. And Rolex is giving out those very rarely, those licenses very, very rarely. So our Watches of Switzerland bet is to some degree a bet, our second derivative bet on Rolex, or first derivative bet on second derivative bet on Rolex actually, and if you think about it, if Rolex raises prices with inflation a little bit more, then Watches of Switzerland sales will go up as much, and half of Watches of Switzerland sales come from the United States, and if Americans spend as much money as the British do, but the other half of sales comes from Britain. It's the largest Rolex retailer in Britain. As much as the British do, I think the sales will go up 6x. Do they have to? Would they go up 6x? I have no idea. But when we bought it, it was so cheap, then this was kind of optionality. I absolutely love, let me tell you a secret about this. This is one of the, so when I invest in stocks, I get very passionate about the products. Now, there's some limitations. When I bought a British American tobacco, I didn't start smoking again, so it didn't go that far. But one thing that happened with me when I was researching what shows Switzerland, I spent a lot of time watching YouTube just to learn about the industry, and the YouTube algorithm confused me for somebody who cares about watches. And it started to feed me all these videos about watches, and I started to watch them. And I actually got obsessed about Swiss watches as well now, a little bit. So, as I started the industry more, just kind of the craftsmanship of watches, I absolutely fell in love with the industry in general. But in my love for, like, I'm going to write about this, is actually not the Rolexes of the world that make 1 million watches a year. But it's like there's some craftsmen make 50, 80, 100 watches a year. And I'm absolutely obsessed with these people. Not as not as a collector, but as somebody who obsessed with somebody else who is so passionate about their art. But anyway, so I think luxury deserves a place in the portfolio at the right price. Over the last many years, it was overvalued. That may change, and I can see myself owning certain luxury brands outside of Watches of Switzerland, but we haven't found any yet. So, but I'm looking forward to own some. Not necessarily the products themselves, but the stocks. So, all right.
Thank you.
My pleasure.
Great answer.
Thank you for having us, Vitaliy. My name is Logan Shear. This is my first time coming to this particular event. You spoke earlier about how you don't take as many big swings because of paranoia. How do you differentiate healthy paranoia from neuroticism or getting overly cynical? And then when it comes to personality, how do you first understand what your personality truly is, integrating that into your own investment process, and then as your own personality changes, making sure your process shifts with that in a way that's still going to work?
That's a great question. Thank you so much. Thank you. There's a saying: you're not really paranoid if they're really after you. So I spend a lot of time almost running this like secondary computer that analyzing the primary computer, kind of looking at, no, honest to God, how, like, analyzing myself all the time, self-diagnosing myself. And that has been incredibly helpful. Also, I have this competitive advantage against many others. By the way, it's everybody else in this room can have this too. I write 2 hours a day. Because you write 2 hours a day, because I write 2 hours a day, I have this 2 hours a day of focused thinking. And in today's world, that is a competitive advantage, because in the world of TikTok, when we're distracted by 30-second videos, focus is a competitive advantage. So that helps me a lot as well. So they also understand that I don't have to be like others. And what I mean by this, just because Warren Buffett bought a stock, or Charlie Munger bought a stock, or Manish Pabra bought a stock, or my friend Guy Spear bought a stock, if that stock doesn't fit, if I don't understand it well, it doesn't fit my investment process or my EQ, I don't have to own it. It's kind of be comfortable being with myself. Yeah, being myself. That's another thing. For me to buy something and make it a large position, I have to have like much higher conviction today than in other times, and it has to have a lot less dependability on other external factors. Like the last time we made a large position in a stock was maybe a few months ago, and for us at this point, it's large. It was a 5% position on day one, maybe within 2 months. We bought healthcare stocks, the healthcare insurance companies. Okay, because I felt I had this very unique insight, and I felt very comfortable with that.
But today, a lot of, you buy a lot of stocks and there's so many other externalities that I'm worried about and I have no idea how they're going to play out. That's why it leads to small positions. Now, over time, it will change. So with some companies, some industries I understand better and I'll be able to, and more comfortable with externalities and they'll become larger positions. I'm just, right now, I feel like everybody's so excited about the market and valuation reflect this, and the world is so uncertain, there's a disconnect. And this is why you wanna be, it's okay to be paranoid earlier. You wanna be paranoid early, not late. So I'm trying to be paranoid a little bit early, in this case. And then, if the market valuations were very attractive and I saw a lot of opportunities, then the problem is high valuations. The range of outcomes they reflect is very narrow, and it's between good and great. But there's a lot of outcomes below that. And there's a lot of external uncertainty that indicates that a lot of outcomes actually will be below that as well. And so when everybody's buying the stocks that's very high valuations, they're basically saying the future is between good and great. And I'm saying, well, maybe not. And so when I buy something today, I want to make sure it reflects, if the other not so great scenarios happen, we're going to be okay. So.
Thank you.
My pleasure. Thank you.
Hi, Vitaliy. I'm Rich Took. I'm from Omaha here. The first time I came across you on Macro Voices with Eric Townsend, and I'll tell you, right away I said, his enthusiasm is amazing. He sounds smart, but I can't keep up. And so I slowed the speed down on you in the podcast, and I go, wow. And so I've been following you ever since. But first go, I can't keep up with this guy. You brought up earlier that AI needs the iPhone moment. Back in 1999, everybody thought Warren Buffett was behind. Berkshire wasn't doing as well as like the Amazons or all the .coms at that time. And then they went public, a lot of them, and then the cash lockup period went by, and then all of a sudden we had all the supply of stock. This year they're talking about Starlink going public, OpenAI, maybe Anthropic, all these companies. If they go public this year, the cash lockups will probably expire next year. Will that put a lot of, you think that could be a defining moment, putting a lot of stock on the market that overwhelms it like it did back then?
It's very much possible. In fact, if you think about the private credit, when they ran out of institutional buyers, they started to open it to the public. And that was the absolute top, right? So, you try to look for patterns in investing, and the pattern would lead me to agree with you, like the past patterns. I don't know, but I just from looking at the past, the history would probably agree with you that they will be selling it. They already exhausted all the institutional buyers, and now it's the patsies. That's going to be buying next, but who are buying a story, like listen, SpaceX may be worth between $2 trillion and 100, or maybe worth 500 billion, which is still a lot of money, by the way. Just we forgot how little, it's, and I have no idea, and I don't have to. But I would not be surprised that the history is going to agree with you. Yeah. So yeah.
Thank you very much.
My pleasure.
Good morning. Thank you for this session, and then this is the first time I come here, and thank you also, allow me to be here. My name is Ning Lee. I'm from Virginia, Fairfax. Drove from Fairfax. So I'm an individual investor. I like investment. Learned value investing maybe about 8 years, 10 years ago. Retire. Still spend a lot of time because I have strong interest, passion in the investment. So my question to you is basically I have two questions. One is the people always talk about S&P, right? And then even Warren Buffett said that for 99 people, they should invest in S&P 500 instead of managing their own money. And my question is, as an individual, should we use the S&P as a standard, right? As a bar, say, hey, if you can do better, then you manage your money. If you you cannot do better, then you leave it to S&P. And then my second question to you is, as a professional fund manager like you, right? You must have a goal as well. And what is your goal? And to achieve that goal, I know you are value investor, having deep analysis on the company, right? And pick up the company. So I would like to know what is your methodology, right? To say, first of all, your goal. What is your goal? Do you want to beat SPY or say, I don't care SPY? Or as long as I find value and I leave time, let the company the stock price going back, and I'm fine. So if that's what's your goal, right? If you have that goal, let's say, assume I want to beat SPY, and what kind of a methodology, or I would say maybe like yesterday, Warren Buffett said, the secret sauce you have, right, to do that. Give you an example. The other day, I went to attend a gathering, a small fund gathering. The manager said that our goal is to beat S&P long term, and then this is our methodology, using option to do the, to get into the position, using option to get out, and managing the cash when we are waiting for opportunity. So I'd like to hear from you, what's your methodology? And sorry, I didn't follow you earlier. Definitely from today, when I come back, I will read more about your thinking and writing.
Oh, thank you so much for this question. So there's several questions inside this question. So number one, should you manage your own money? Should you find a money manager, or should you buy S&P? So if you're going to manage your money the way I used to manage my own money, like just watching CNBC and buying a stock, you might as well buy S&P. Okay, just because that's if you are very passionate about it and you have a process. So just stop for a second. So I already told you what I think S&P is going to do most likely over the next 20 years, not very much. So then you have to look, okay, so if I'm going to make over the next 20 years between nothing, maybe a little bit, or actually lose money, or lose buying power, purchasing power, then what are my alternatives? Then I would argue value investing in general should do better than that. Now, if you want to do it yourself, you want to find somebody who you trust, that's your choice. Now, I don't. This is not the answer. The answer may surprise you a little bit. I don't compare myself to S&P, and let me explain why. Because we are playing a very different game. My game, number one, is to survive, okay? And because this is like when you run a mutual fund, when you run a mutual fund, you basically manage faceless people money. Like you just, I actually know my clients, and therefore I want to make sure that actually when they retire, they have more money, not less money. If I'm trying to play beat the S&P game, I'll be taking very different risks. And my time horizon will be different. So what I'm trying to do is to grow their wealth, preserve and grow. And therefore, my decisions are going to be like a little bit more paranoid, a little bit more diversified. Again, it's not going to be 100 stock portfolio, but it's used to be 20 stock portfolio, now it's 30. Okay, and if in the process I'll do better than S&P, well, let me put it this way. If I just told you what I expect from S&P, if I do, I can't promise make any cut. This is we're SEC regulated investment advisor, so I got to be very careful. I'm making no promises. I cannot make any promises because I have no idea. But I hope I'll do better than zero, right? Okay, so it's S&P is going to become a very low bar. I guess that's my point. But that's not my focus. I don't wake up in the day, in the middle, I don't wake up in the morning and think how I'm going to beat S&P. I'm just looking to find high quality companies that undervalued, build a portfolio of them, and the returns are going to be byproduct of that. And that's what I can control, my process. What S&P does, it's external. I have no control over that. When somebody tells you they're going to do, they want to beat S&P by this much, those are aspirational things, and they have no control over, because again, they can't control what S&P does. Listen, S&P can still double tomorrow because crazy things have happened. Okay, and I have no control over that. All I can do is just do the best research possible, be as rational as possible, and then I'll be fine, and my clients will be fine. If their neighbor owns S&P and the neighbor is going to make more money, that's great for the neighbor. If the neighbor loses a whole bunch of money, I feel sorry for the neighbor. I'm not worried about the neighbor. I'm just really worried about my clients and I guess my own assets as well, because the management of my firm. So I hopefully answered your question.
Thank you. Thank you.
Awesome. Well, thank you everyone for coming. We have hard stop at 11.
No, just 1 second, Jonah. Yeah, I'm going to overrule you a little bit. We already have, how many people lined up? We got 5 people lined up. I'm going to try to answer very quickly. But you got to help me ask specific questions because you're fighting with him now.
Oh my goodness, yeah, I can see that. Vitaliy, thank you so much for this event. I really feel that it's like listening to a young Warren Buffett, and I've been very grateful attending these events for a couple of years now. So last year, what you mentioned was, we were in an environment about, investing between the tweets, and you also mentioned that IMA's portfolio don't look at the 13F filings because a majority of the portfolio was invested outside the United States. How does it look these days?
I think we are, by the way, just if you look at 13F, that's the filings we have to do legally. They only show our US stocks. They don't show our foreign stocks. And the foreign stocks, they're probably more than 50% of our portfolio. So that hasn't really changed that much. So, yeah. So our 13Fs are not really, does not tell you that much about what we do. So, yeah.
Can I ask a follow-up question then?
Very quick, yeah.
Okay, because the next question is which countries are you looking at?
So we try to I really try very hard to invest outside of Europe because we have a plenty exposure to Europe, looking in Asia, excluding China, Latin America, and we bought some Latin American stocks. But I have plenty of exposure to Europe, and I want to have exposure to countries outside of Europe. So yeah. Right.
Thank you.
Hi.
Hi, my name is Jamie. I'm from San Francisco Bay Area. And the comment you made about Waymo and Uber kind of inspired me to come here to ask the question, because we see so many Waymos in our backyard now. We live right outside San Francisco. So I guess 2 questions all related. Waymo, Uber, BYD was sold 100% by Berkshire already. And then Tesla is way, way overvalued, I'm sure, from your perspective. So the question is, say, I know you just said you don't invest in China, but would you consider BYD at a certain level? Just because now BYD is like #1 in terms of EV sales, right? And if Tesla ever come down to some level, is that a company that you will ever consider if the valuation is good?
All right.
From your perspective.
I'm going to try to be succinct. I don't have an opinion on BYD at all. Okay. Tesla, I have no idea because I'm not sure what it is. Is it a car company, robots company? Is it going to be owned by SpaceX in 6 months? I have no idea about Tesla anymore. Mm-hmm. So that's.
But you still love Uber.
I love classical music.
Okay.
Okay, and so I.
But you do think Waymo, in your opinion, said earlier that probably
that
dominate.
thing hasn't changed. But
okay.
I preserve my love for my kids, classical
Sure.
music.
Sorry, I don't mean love.
No, it's all right. It's all right. But anyway, thank you so much. Thank you.
Okay, thank you.
Good morning, Vitaliy. Ian from Calgary in Canada. Thank you for taking the last 5 questions. Jonah's probably going to make sure we don't get an invite next year to keep it on schedule. Looking at your portfolio, there's a clear trend of some of the companies you're invested in improving their relations with their main customers and their workforces. Uber and Babcock in particular. To what extent do you value the potential for creation of a sustainable ecosystem in your investments, and how do you value it?
I'm trying to, you got to double click on this a little bit because I'm not sure I understand.
Yeah, for sure. So with Babcock specifically, you've written about how they've greatly improved their relationship with the government in the UK, which is one of their main clients. And now the government views them as a partner rather than just a supplier. How do you factor that into your investment thesis?
Listen, it's so simple. You want to own companies that keep getting better, right? Have better relationship with employees, customers, etc. So have an optionality to go into new markets that are run by people who are highly ethical. So the biggest change, one of the biggest changes in our process of the last 5-10 years is that focus on people. And I just want to own companies that run by great people. And that's probably more, and great people gonna have great, customer relationship, great employee relations. So that's what we focus on. So, and that's a kind of, in investing, all you're looking for is just little competitive advantages, little, kind of improve your odds little by little with every decision. Company that has better management, more rational management, is just another competitive advantage. So just another little improvement. So yeah.
Awesome. Thank you.
Thank you. All right.
Hi, Ram from Texas here. Thank you so much for sharing your wisdom for free for a while now. I've been following you, and also thank you for letting us finish the questions. That speaks about what kind of a person you are, and really appreciate it. Coming to my question, it's more of I'm trying to reconcile some of the statements that you have made earlier. You talked about inflation, how you see inflation going up with the debt and the money supply expanding, and what happened during COVID in terms of money supply is unprecedented. So that speaks to me that multiples are going to be expanding more. It kind of justifies when inflation is high, people are pouring more money from bonds and other assets where purchase power is not guaranteed into the stock market. Combining that with the S&P 500, like including you, Warren Buffett, everyone is advising younger generations who are not so passionate about stock picking to simply go to S&P 500. And I see with younger generations that they're more comfortable just doing passive index investing, and they're getting more comfortable allocating more and more. That also speaks to margin multiple expansion, but not compression. So I'm curious on why you made that statement that you see, or you kind of predict that the earning multiples are going to compress in the upcoming year. Would love for you to walk us through, like, what's your thought process? Why do you think that happened?
Thank you for this question. Thank you. So let me challenge your thinking a little bit. So during an inflationary environment, earnings, if you own a company that has pricing power, then its earnings will grow with inflation or higher, whatever, okay? But the earnings will reflect inflation. The price to earnings historically, when inflation picked up, actually declined. So that's an assumption. So you mentioned that you think valuations will go up. That's not necessarily the case. So the stock price, so you have the two conflicting forces. So you have nominal earnings growth on one side, but then at the same time, if the company has high PE multiple, you'll be discounting future at higher interest rates. Therefore, multiples usually decline. Okay, so I am not sure that necessarily. So that's number one. Number two. People are a little bit Pavlovian creatures, and we do what worked in the past. S&P 500 worked great in the past, and that's why we keep doing it. That fulfills momentum, but things that can't go on forever don't. I don't know whether, when the don't part comes, and nobody does. But at some point, people will say, well, right now everybody says you should own this. you should know S&P. At some point, people will say you don't want to own S&P because when you look at several years of negative returns, you're going to say, I don't want anything to do with that. So I don't know when that moment is going to come, but at some point, it's not going to be like, you'll be looking for other alternatives. So I think the future of value investing is as bright as has ever been because I'm competing with people mindlessly buying everything. That's what the IQ of the market declines every single time people buy an index because nobody's analyzing those stocks. Anyway, so thank you.
Thank you for the warning. It's kind of rare in this environment where everyone makes S&P like a monster. We need people like you to warn people. So thank you so much.
My pleasure. Thank you.
Hey.
Okay, 2 more questions.
Yeah.
Yes.
Okay, sure. Yeah, my name is Jenny. I'm come from California. So I have a few quick questions. So number one, I heard you said you expect the SP 500 will return very little or zero in next 12 months. Do I hear correctly from you?
I think I meant not next 12 months, next decades.
Next decades?
Yes.
You mean SP 500, you expect they will return very little or almost zero or even negative, is that right?
I think, all right, so you asked me to repeat what I already said. But basically, let me do this just to save time. If you read my little book of Sideways Markets, or this is going to be recorded, then you can watch the video and I answered this question already. So how about this? But the bottom line is next 5 or 10, 15 years, the returns of the S&P 500 I expect to be either very little or negative, basically. Yeah.
Okay, then let me quickly ask for like an ordinary investor. Okay, so 2 ways. One way is that he's going to invest himself. Okay, just give you the profile. Like a 50 years old engineer client right now has a lot of cash, and let's see, risk tolerance is moderate to aggressive, and the investment horizon maybe is 10 to 15 years. So if he want to invest by himself right now, because he has a lot of cash, should he, like Warren Buffett, just hold a lot of cash, wait for market crash, or should he, let's see, maybe pick the top holding from your SEC filing, your top stock, or maybe just the dollar cost averaging into SP 500 and NASDAQ, or even some international index fund. Which way, if he invests by himself, which way do you recommend? And the second question is, if he try to seek professional advice, how should he pick different, like say, portfolio manager, different wealth management advisor, and besides looking at their historical average return and expense ratio? So that's my 2 questions.
All right, there's so many questions. So to be kind to the audience, I'm not going to answer the same question twice. So some of the questions you asked I already answered, so okay. I'm going to not answer them. So as I mentioned, so the worst thing you can do is this. You can look at my 13F and say, Vitaliy bought this stock, and I'm going to buy this too. And in fact, I'm going to beg you, please don't do this. And I really mean it, because I want to be a net positive to the world. I honestly do. This is like somebody asked me what drives me. Every interaction I have with people, I want it to be net positive. The last thing I ever want is somebody buy the stock I bought, and then what? And then they may lose money. And actually, by the way, that has happened to me. And we bought this company. I never wrote a single word about it. The only thing that happened is showed up in our 13F, and I was wrong about this, and we sold it. And but then somebody writes this angry angry email to me or tweet, I forget what it was, kind of crucifying me for owning the stock. And I couldn't understand where it's coming from. And then when I talked to this person, I realized he just looked at my 13F, and I already changed. First of all, I was wrong about this. I changed my mind, etc. But that person actually was actually lost money on this. And for us, it was a small position. For this person, it was a large position. So please, I beg you, do not look at my 13F and don't buy stocks without doing your own research and coming to the conclusion that you want to own the stock, not because Vitaliy bought it, but because you think it's a good investment and you come to this on your own. How to look for an advisor? You basically look for two things. You look for somebody who is a good character, so somebody who's going to be honest, and somebody who is competent, and somebody who's going to fit your philosophy. That's how you would look for an advisor. And other questions, I already kind of answered them before. So, and about what the market's going to do next, I'm going to do a shameless plug for my two books, the Active Value Investing and the Little Book of Service Markets. And then there you can read about that. But thank you so much for your question.
Thank you.
All right. One last question. Actually, you know what? I'm going to make an exception because this is the sweetest person in the room. But I'm going to come to you last, okay? Right here.
Hello, yes. My name's Clint Murray. Recently relocated to Denver, Colorado.
All right.
This is my first time attending this, so thank you for hosting. My question, I'll keep it succinct, but relates to your long-term view of the S&P 500 and American industry as a whole. The pre-tax corporate margins recently, I think last quarter, hit about 11.5%, which historically are very high. And there seems to be a step change in corporate pre-tax margins post the great financial crisis, step change upwards.
Yeah.
And the average return on equity of American companies, I think last quarter hit about 14.5%, which is rather exceptional. So those two things, to me, indicate strong tailwinds if you assume that those persist at those relative rates. So I just want to get your thoughts. Where do you think corporate pre-tax margins go over the long term, as well as corporate returns on equity, and why?
All right. I'm going to try to keep my answer short because Jen is looking at me and he's giving me the smile that I'm afraid of. But let me just answer your question. It's actually, so in the past, corporate margins have benefited from globalization, low interest rates, low commodity prices. Interest rates are going higher. We are going through deglobalization, and commodity prices are going higher as well. So also the companies in the S&P 500, like the Googles, the Metas, the Amazons, used to be asset-light businesses, maybe not Amazon, but Metas and Google. Now they are spending hundreds of billions of dollars a year on capital expenditures. That's not helpful to their margins long term. So I'm thinking, corporate profit margins probably going to go the other way. So for these reasons. All right, thank you so much. All right, and I'm going to let you to ask look at this guy, look at this smile. He's a incredible doctor from East Coast. I gotta answer your question.
Thank you so much for your generosity. My name is Dr. Javed. I practice in South Dakota, and two things today, a comment and a question. Comment is you have written the best book, Soul in the Game. Oh. And just to let everybody else know, initially when I told Vitaliy it's a good book for parenting for fathers, last year we discovered it's a very good book to be a good doctor. So I was honored for a keynote speech for a graduating class of physicians. 1/3 of my speech was based from your book.
Oh my God.
Soul in the Game. Because if a doc has their soul in the game, that's the doc you want because they'll care for you. And just an amazing work that you created. I think it's going to be one of the best books going forward. I make all of my students, people who I mentor, go through that book, read it before I start my mentoring because that becomes a good foundation. So thank you.
Well, thank you so much.
My question is that will you continue this event going forward? Because it means so much.
The answer is very simple. As long as you guys keep coming, I'll keep coming back as well. So how's that?
Thank you.
Thank you very much. Thank you.
Okay. I'm gonna try this one more time.
All right.
I'll do my best.
All right. No, guys, thank you so much for coming. If you want me to sign books, I'll be outside. If you want to ask questions, it's a truly pleasure, and I hope to see you next year. How's that? All right. Thank you.
And quick announcement, we will have amazing authors outside signing books and selling copies of their books. And if you had a question you wanted to ask, Vitaliy would be outside answering questions, so please attack him.